Hello friends. On July 22nd, Alphabet, the parent company of Google, reported its Q2 2026 earnings. Google Cloud grew a stunning 82% year over year. That is a record. But the very next day, Alphabet's stock fell more than 7%, one of its worst single days in over a year. How does record growth trigger a sell-off? The answer is capital expenditure, which just means the cash a company spends on physical infrastructure like data centers and servers. Alphabet spent $44.9 billion on Capex in one quarter alone. That spending wiped out its operating profits and pushed its free cash flow negative for the first time since the company went public in 2004. This week, Microsoft and Meta report their own earnings. In this video, I will give you the exact framework to read those numbers intelligently. Alright, so what exactly is capital expenditure, or Capex? Think of it like this. Imagine you open a bakery. Before you sell a single loaf, you spend money on ovens, counters, and the building itself. That upfront cost is Capex. You use those ovens for years, not just one day. Tech giants do the same thing. When Amazon or Google build a new data center, or buy thousands of custom AI chips, that is Capex. It is real cash leaving the door today, but those assets generate revenue over many years. Here is the part that trips people up. Capex does not appear on the income statement, which is the report that shows profit and loss. It comes out of the cash flow statement instead. So a company can look profitable on paper, while its actual cash is shrinking fast. That is exactly what happened to Alphabet in Q2 2026. Now here is the scale of what is happening across the whole industry. The four biggest players in cloud AI, Amazon, Alphabet, Microsoft, and Meta, together plan to spend roughly $725 billion on infrastructure in 2026 alone. To put that in perspective, that is up about 77% from roughly $410 billion in 2025. Amazon leads with $200 billion budgeted. Alphabet is close behind at $195 to $205 billion. Microsoft sits at around $190 billion, and Meta is in the range of $125 to $145 billion. Every single one of these companies raised its Capex guidance this year, some of them more than once. Investors are asking one very direct question. Is all of this spending actually going to turn into revenue? That is the question the next three signals will answer, starting with the clearest early proof point, which is cloud revenue growth rate. Cloud revenue growth rate is your first signal. Think of it like a report card. When a company spends billions building data centers, the question is, are customers actually paying to use them? Cloud growth rate answers that directly. In Q2 2026, Google Cloud grew 82% year over year, hitting $24.8 billion in a single quarter. That is a strong sign that Alphabet's infrastructure spending is being put to work. Azure, Microsoft's cloud platform, guided 39 to 40% growth for Q4 of its fiscal year 2026. And Google Cloud's contracted backlog, meaning future revenue already committed by customers, hit $514 billion. A rising backlog tells you demand is real and locked in. Now, growth rate alone is not enough. Cloud growth shows the platform is selling. But you also want to know, are real people paying for AI features specifically? That is what seat counts and arranged by tell you. ARR stands for annual revenue run rate, which means the recurring revenue a product is on pace to earn over a full year. Microsoft reported its AI business hit $37 billion in arranged by in Q3 FY 2026, up 123% year over year. On top of that, more than 20 million people are paying for Microsoft Copilot, the AI assistant built into Office tools. That 250% plus seat growth says customers are not just trying it once. They keep paying month after month. That kind of sticky, recurring revenue is exactly what investors want to see. Free cash flow is the most honest health check. You calculate it by taking operating cash flow and subtracting Capex. In Q2 2026, Alphabet brought in $39.1 billion in operating cash flow. Then it spent $44.9 billion on Capex. Subtract those, and you get negative $5.9 billion. That is the first negative free cash flow Alphabet has reported since going public. So what are investors actually debating? It is the time gap between spending and earning. You build the infrastructure today, but revenue flows in over years. Meta gave us an early sign that the wait can pay off. In Q1 2026, AI-powered ad tools lifted advertiser conversion rates by over 6%, pushing ad revenue up 33% year over year. That is monetization starting to show. Next, let's turn all three signals into a practical checklist you can use when Microsoft and Meta report tomorrow. Alright, so here is your practical checklist for tomorrow. Microsoft and Meta both report on July 29th. First, watch Azure growth rate. The guidance is 39 to 40%. A beat tells you the infrastructure is earning. A miss raises questions. Second, watch Copilot paid seats. They passed 20 million last quarter. Are they still climbing? Sticky seats mean real recurring revenue. Third, check updated Capex guidance. Did it go higher than last quarter, or is it holding steady? Higher Capex with slower cloud growth is a warning sign. Fourth, listen for any free cash flow stabilization language. Management hinting the gap is closing is a meaningful signal. Those 4 numbers tell the whole story. Big Capex only makes sense if the revenue follows. Now you know exactly what to look for. Thanks for watching, and we will see you in the next one.